tonight session. So we'll do that. And tonight we'll do a little bit of math, not a whole lot, keep it simple. One thing about trading is you don't have to be real good at math, but you do need to know how to do some adding and a little bit of multiplication. But that's what they make calculators for, so it'll be pretty easy. Let me just make sure I get this thing set to record. Yeah, I like Zoom sometimes, and then I don't like it other times when I'm like trying to find the buttons that I'm looking for. All right. All right. Pull this chat window so I can see it too. So if y'all got anything while I'm going, definitely stop me, let me know, and I'll go back and kind of repeat some stuff. So let me hit the record button. All right, so when we kind of left off last week, we looked at the different currency pairs known as the majors, MAJORS, the majors, major currency pairs that are traded in the Forex market, the 8 majors, the euro, the dollar, the pound, the franc, Canadian dollar, the yen, Australian dollar, and New Zealand dollar. So memorizing those 3-letter designations, which country and what they call their currency. And then that 4th column is the nickname of the currency. So those are the ones that you definitely want to memorize as we're going through the actual, as you actually trade in the markets. Again, you have those other currencies that you can trade, like the pesos and the Chinese yuan and all these other smaller currencies. But the most traded currencies are these 8. These are the most volatile ones. These are the most liquid ones. These are the ones that have the most money that are going through them on a daily basis. So those are the ones I personally stick to for the majority. And then also we have the crypto markets coming up now. So a lot of people are crypto trade. And so as you kind of learn these majors in the Forex world, you kind of learn the major crypto pairs as well, the Bitcoins, Ethereums, Litecoins, all these other different ones that are coming up. We can also trade those as well. If you guys were able to attend the crypto launch IML had I think it was last night's webinar. They actually have the crypto stuff now in the back office. So you can actually start going back there and attending live sessions of crypto trading too. So I want to make sure I threw that out there before I forgot. So I haven't had a chance to kind of watch the webinar myself, but definitely can go out there and learn from some of the other guys that are trading cryptos on a regular basis. What cryptos that are out there that you can trade, how to set up the broker platforms and all that kind of good stuff for crypto specific. So you get a lot of stuff through iMarkets Live, which is pretty good to really how to learn how to trade these various markets. And Forex and the crypto markets are probably the best ones to trade right now. All right, so let's kind of do some math tonight. So tonight I'm going to get into actually looking at these currencies, how to read them currencies, and how to kind of anticipate your profit and loss based on the market movements. And we'll look at charts a little bit here towards the end. So currency quotes. So when you're looking at that ticker or you're looking at the actual price chart of these currencies, these Forex pairs, you're always going to see the pairs, the currencies quoted in pairs. So you'll see 2 countries side by side and separated by a backslash. You're never going to see it just say the euro at a certain price or the Great Britain pound at a certain price. You're always going to see it listed as a pair. And this pair is basically what's known as the base and the quote. So the base currency is going to be the currency that's on the left-hand side, and the quote currency is going to be the currency that's on the right-hand side. So definition to know, but it's not something that you're going to use probably in the next week. It'll be like nothing to you. But you definitely want to know that the base currency is always going to be on your left, and the quote currency is always going to be on your right hand side. Now, you're also going to have to learn the different way these things are listed. So, for example, you're seeing Euro USD. You're always going to see it listed as Euro USD. You're not going to see it listed as USD/Euro. So, unless you're trying to do some type of conversion backwards, you're always going to see it in certain orders. So we won't go through all the different orders. You definitely see those as you're actually going through your chart platforms and you're looking at the actual scanner. We'll try to set up the scanner on Thursday for everybody that hasn't set up the scanner. But you're always going to see the currency pairs listed a certain way. So Euro USD, and it says 1.1250. So what this essentially means is that 1 euro, which is the base, is going to be equal to 1.1250 US dollars. So that base that's on the left is always going to be equivalent to 1, whether it's 1 euro, $1, that might be on the left hand side, like the second example. If we go back up to our previous slide here, GBP USD, that second one, the base currency is GBP, which is equal to 1, and the quote currency is USD. And the third example down there is the AUD USD. So 1 Australian dollar is equivalent to 0.7510 US dollars. Okay. So you're always going to see it quoted a certain way. And you just have to, just one of the things to memorize as you see them. Make sure you're talking the right language. You don't want to go to talk to somebody and say, hey, what's the USD JPY or what's the JPY USD actually doing? Is my screen? Hold on. I'm missing a little thing around the screen there. I'm gonna make sure my screen is showing. All right. So base currency is on your left, and the quote currency is going to be on your right hand side. Okay. So let's go down here. Next slide here. Sorry, tonight's one of them slides. Nights again. After tonight, no more slideshows. I think I promised that. Currency positions. So I remember back when I was first starting learning how to trade Forex and try to understand the language of Forex, and I was trying to figure out what this PIP is, PIP. So I remember asking people, what is a PIP? The PIP is essentially this position in the currency pair, which is the fourth position in a currency quote. So when we trade money or buy things with our money here in the US, we go to 2 decimal places. You go buy a soda from the store, it's $1.19. But when we actually trade the Forex markets, we actually trade to the 4th decimal place. So we really are able to make some money off the smallest increment value of change. So the PIP is going to be the 4th decimal place in these currency quotes. So the 4th decimal place after that decimal. So the Euro USD in this example here, if the price is quoted at 1.0445, it would actually be the PIP value. Now, when you're out on the internet and watching videos and people are saying I'd make X amount of pips, you want to be sure that they're actually talking about the 4th decimal place, because I'm going to show you here on the next slide that the 5th decimal place is actually referred to as the pipette or the fractional pip. Now, some people will actually say that they've made a whole bunch of pips, but they're actually counting the fractional pips. So when they're telling you, for example, I made 100 pips, they didn't really make 100 pips if they're using the fractional pip. It's more of a sales pitch. They probably only made 10 pips because they're actually counting that 5th decimal place. When we trade the Forex markets, we are really looking at the 4th decimal place, not that 5th decimal place, just because you'll see in the math here that 5th decimal place is really, really small. So we are trading to the 4th decimal place, and that's the position that you really want to be cognizant of when you're actually trading the markets. Now, the exception to the 4th decimal place and 5th decimal place rule is to any currency that is associated with the Japanese yen. So when it comes to the Japanese yen, we're only trading to the second decimal place. So in this example, USD JPY at a price of 113.49. The 9 is actually the pip. And if we traded down to one more position after that, that third decimal place would be the pipette. So any pair associated with Japanese yen, we're only trading at 2 decimal places. So if we were looking at the Great Britain pound versus the JPY, we're only going 2 decimal places. If we're looking at the Australian dollar versus Japanese yen, we're only going 2 decimal places. Okay. All right. Position sizes, very, very, very important. So I like to spend enough time on here. So if you got questions, definitely let me know, because this is an important one that you definitely want to know. Otherwise, you will either kill your account really fast or you might grow it really fast. It just depends on what side of the trade you're on. So the thing about the Forex market that's different from the stock market is in the Forex market that we actually have what's called position sizes, equivalent to lot sizes. Okay, LOT, lot sizes. So in the stock, you'll type in how many shares of stock you want, and that's your position size. In the Forex world, we have some called lot sizes, and it works a little bit differently. We have something called a micro position size, a mini position size, and a standard position size. Now, a micro position size basically means that you're controlling $1,000 worth of capital in the particular currency pair that you're trading. It doesn't mean that you actually have $1,000 in your account. Doesn't mean you have to have $1,000 in your account, but it means you're able to control $1,000 in your account. And for every value that the pip increases or decreases, it's worth 10 cents. Now, this is all based on USD pairs here too. A mini position in the market basically means you're controlling $10,000 worth of money. And for every pip value that goes up or down, is worth 1 pip. A standard position is you're controlling $100,000. You don't have to have $100,000 in your account, but for every pip value that goes up or down, it's actually worth $10 a pip. Now, these are based on USD. So this basically means that any pair that has the USD in it, we have these 10 increments. Okay. So USD JPY, GBP, USD JPY, GBP USD, NZD USD, anything with the USD that you're associated with in the currency pair. These micro, mini, and standard positions are all based on these values of 10, the 10 base values. Okay. Now, if you're trading something called a cross currency, which is basically any currency pairs that does not include the USD in its pair, so basically anything that's just not USD, then these values are slightly different. And this website here below will actually give you what the exact values are, because these actually are constantly changing along with as the value in the markets are constantly fluctuating. So I will bring this up real quick so we can kind of take a look at it so you can kind of see what I'm referring to here. Right, this is just softinvesting.com. So let me blow this up a little bit here. So we see here, if I kind of just quickly go through anything that's USD associated with, we see that the standard lot, $10 a pip, our mini lots, $1 a pip, and our micro is 10. Okay. Now, if I look at these other pairs, you see right below it that this is slightly different. If I traded the Canadian dollar versus the Japanese yen, it would be worth $8.84 if I was trading a standard position size. 88 cents if I was trading a mini lot size, and 9 cents if I was trading a micro size. Okay. Again, USD, you see we have the 10 base value for everything that's USD, GBP, USD 10 base values, and anything that's not a USD associated pair, If you're trading it, you might want to be aware of what the actual pip value is worth. Reason being is because sometimes you have some extremes. They're not crazy extremes, but you do see something like here where the Euro GBP is actually worth more per position size. So instead of being worth $10 a pip, it's worth $13.57 a pip. And then $1.36 versus $1, and then 14 cents versus 10 cents a pip. So there are some outliers here. I'm not even sure what the BRL is off the top of my head, but you see that here, instead of being $10, it's only worth $3.09 if you're trading a standard lot. So anything that's not USD, you might just want to kind of quickly run through here. So when you're actually taking your trades, you actually know how much you're risking per trade. So this is just writeoffinvesting.com, and then I copied it in the chat as well. And it's a free website. You don't need to sign up for anything to get access to that. All right, so we'll do a couple examples here, and then we'll kind of look at it on the chart real quick as well. So example number one, we're basically going to say that we entered the market at the Euro USD at 112.20. So we're going to get into the market at 112.20, and we're going to buy the Euro USD pair. So our first exit price will be 112.50. Okay, so we bought it at 112.20. We get out at 112.50. Let me grab this little pointer tool here so I don't have to click and highlight. Okay, so 112.50 is where we're getting out at. 112.20 is where we're getting in at. So the difference is 30 pips. Okay, so I'm looking at that fourth decimal place and that third decimal place. If I take 112.50 minus 112.20, I get 30. So that's 30 pips that the price actually increased. Okay, now based on how many pips, you know, we went in either direction here. In this case, we went up. So 30 pips, we went up. Now, if I was taking a micro position size and I gained 30 pips, then that means each of my pips is worth 10 cents per pip. So I essentially made $3 because 30 pips times 10 is equal to 3. If I took this same trade, but I took a mini position size, so I took a size that was a $10,000 position size, and it went up 30 pips. Each pip is worth $1. 30 times 1 is equal to $30. Okay. Standard position size, $100,000 I'm controlling in the market. If it goes up 30 pips, 30 times 10 is a $300 day. And that's a nice day if you're just making 30 pips one trade. Okay. Now let's kind of look at it on the other side. If we were actually selling this pair, okay, or well, I'll put it to you this way. First, if we took this same trade and we bought at 112.20, okay, and instead of the price going up, we thought it was going to go up, and it actually went down this time. So we're going to say this is a losing trade. We still want to be able to know how much we risk, because that's the name of the game with trading, risk management. So 111.70 is going to be our price that we end up getting out, and we cut our loss because we're noticing the trade is going against us. So the difference between 112.20 and 111.70 is actually 50 pips. Okay. So 112.20 minus 111.70 is equivalent to 50 pips. If the math doesn't make sense, definitely let me know, and I'll go through it again. So we have this difference of 50 pips. Now, if we take our 50 pips and we had a micro size, then the 50 times 10 cents would have been a $5 loss. If we had 50 pips and we took a $10,000 position size, 50 times 1 would be $50. And then 50 times 10 down here for standard would have been $500. So you definitely want to be able to do the math on both sides, whether you're when you're in that position, you want to know how much you're risking. So if you don't want to risk a $500 loss, then you don't want to risk a standard position size, okay? Or you don't want to risk a standard position size, or you want to cut down on how many pips you're going to risk, okay? All right. Any questions on that? Good to go on that? All right, we'll keep going. So taking a look at another example here, USD, excuse me, USD JPY. This is just kind of some math here. So if USD JPY was at 101.40 and it went up 110 pips, what would that be? So I kind of use this slide to kind of do some math. So 110 pips plus the 101.40 is equal to 102.50. So basically, if I take 101.40, quick math, if I add 60 to it, I get to 102, right? And then our ending price was 102.50. So, or I'm doing 110 pips. So add another 50 to it plus 50, I get that 102.50. So if you don't know how to add pips or see how to do the adding and subtracting of it, definitely let me know, because you definitely got to learn how to do that as you're going through it. And the videos in the IML Academy kind of break it down even more as well. So I kind of use this as make sure I highlight some key points, because we don't have time to really do all of this if you guys really want to learn some chart and stuff. So again, here 112.80 Euro USD. If it goes down 50 pips, that means I'm taking 112.80 minus 50, and my end result is 112.30. Okay, so 50 pips. All right. I don't want to go through that part. Okay. All right. Any questions on that? Because the next part is going to be good. Let me bring up Word document. All good. All right, cool. All right, so let me switch the silver to portrait. And now we're going to jump into leverage. The great thing about the Forex market is you have leverage. Unlike the stock market, you do have some brokers that give you a little bit of leverage, but in the Forex world, we have a lot of leverage. And if you know how to use leverage correctly, it can be very, very great. If you use it incorrectly, it can be detrimental to your account. So definitely understanding leverage and using it correctly will be very, very good to really help you grow small accounts larger and faster. That's really the benefit of leverage. Now, in order to talk about leverage, I got to give you everything. So in the US, we essentially have what's called 50-to-1 leverage. So for every $1 that we put into our trading account, the US government allows us to have up to 50 times that we can trade in the foreign exchange market. So for example, if we start off an account with $500, we basically are able to control, kind of going back to our last slide for position sizes. Let me grab a calculator so you can actually see it on the replay too. So we take our $500 that we start our account with, that we, deposit from our bank account or upload from our debit card, however you do it, $500 times 50, because that's the max amount of leverage we can have in the United States, means that I can control $25,000. Okay. So I can control $25,000, but I only put in $500. Okay. Now, in the US, that's what you're limited to. Now, you also have European, or what they call overseas. So I'll just say overseas for sake of time. Overseas brokers are any brokers that are not established and founded in the United States. So the positive of that, if you choose to use an overseas broker, is that you actually have more leverage. The downside of using an overseas broker is that you do not have the regulatory bodies watching over your account. So the SEC and the CFTC are the government governing bodies of the United States that watch over these investment accounts, these financial institutions, make sure they're doing what they're supposed to do, make sure they're protecting you and all that good stuff. So that's what you have in the US. You have security, but you don't have the amount of leverage to really maximize these markets. And so even in the crypto market space right now, there's a lot of companies that are getting either getting shut down or they're getting hold on one second. Uh, hold on a second. All right. See, these companies are getting shut down because they don't have uh, regulatory bodies governing them, and they're trying to operate in the United States. So that's one thing that you definitely want to keep in mind, depending on which brokers you use. I personally use both brokers. I use U.S. brokers and overseas brokers. Overseas brokers will give you a lot more leverage. So there are brokers that will give you, and I mean, even this is still light, will give you 1,000 to 1 leverage. Okay. So you're basically putting up the same amount of money into your brokerage account, except you're getting a lot more leverage. So if we take 1,000 to 1 leverage and we start off with the same $500 that we put into our account, right? So 500 times 1,000. Don't have to be good at math, just need to know how to use a calculator these days. Equals 500,000. So essentially, I'm able to control a lot more money than I can in an overseas brokerage account than I can in a US account, starting with the same balance. So we started with 500 here and we started with 500 here, but leverage is what allows us to control more money. So when you're opening brokerages accounts, then you can look and see what leverage they actually give you. We'll take a look at one real quick and I can kind of show you an example. JAForex.com. So I'll type it in the chat so as well. And the reason that I chose this particular one is because they're partnered with iMarkets Live for the scanner. So when we install the scanner, we'll use this broker. Um, so as soon as it comes up. And this particular broker also allows you to trade cryptos as well. So I like having all that in one place instead of having to open up multiple accounts all over the place and log in all the time. So we'll wait for it to load here. Let's try and come on. Let's try it on a different browser. All the brokers will tell you what their leverage amounts are. Leverage is based on a couple things. It's based on what the broker, what your balance is. They'll give you a certain amount of leverage based on your account size. That's not working. I'll give it a minute. And then we'll look at US broker Owanda as well. So hopefully that'll come up in the background. So Owanda is a US broker. Let's see if we can find it on their page. I don't know where they move all this stuff around to. Forex trading. All right, so they don't specify it on here. But if you use any broker that's based in the US, you're going to get that 50-to-1 leverage. And a couple other overseas brokers that you'll see in the so okay, they're not doing Talinex no more. FX Glory is another overseas broker. And here they offer up to 3,000-to-1 leverage. Website is slowly but surely coming up. So that's FX Glory. I'll put that in the chat too. I'm not telling you which brokers to open because I should tell you to open US brokers, but I give you everybody the information so they can make the decision up to them. But when you're on JAFX, they actually show it too. So I haven't spent a whole bunch of time on that. You can definitely look and see. But more leverage basically allows you to control more money. So if I kind of go back to this slide, back here with position sizes, you can see that if you, that first example, we can control $25,000. So that basically means we can control 2.5 mini lots. Okay. So that first example, $25,000 is what we can control. We can control $25,000 worth of or 2.5 mini position sizes. Okay. If we took that same $500 and we traded on an overseas broker that gave us 1,000-to-1 leverage, we can control $500,000. So we can essentially control up to 5 standard lots, which is a lot more. And taking, bigger size trades where you can really grow an account based off a small amount of starting capital. That's what's the beauty of the Forex market. You don't need a lot of money to get started. A couple $100 in your account to get started. You can definitely grow that based on position sizes that you decide to take. All right. So let's jump back over here. All right. So leverage makes sense. And then we'll pull up a chart here. So we're going to go into, I haven't pulled this up all day because I don't trade on Mondays. So first time I'm even looking at the charts for the week myself is always on Mondays because I don't trade Mondays personally. All right, so let's kind of look at an example using the actual scanner. And let's see if we can find something that's kind of already happened. So, and then as we actually get through some stuff, we'll do a lot of back testing. All right, let's take this. Okay. All right, so we're going to kind of use this example right here. This is the USD JPY on a 4-hour chart, and it's giving us a price. We'll really go through this, how to use a scanner and install it on Thursday, but just kind of showing you guys how we can kind of see what you're getting. So it's actually showing us the entry price of 113.55.2 off this green line, and this is the price that's kind of telling us to get in. And then it's giving us these take profit levels. Okay, take profit 1, take profit 2, take profit 3. So we can stay in these trades as long as we want to. The take profit levels are essentially where this pattern is expected to go. So we're just going to keep it simple and use take profit 1. So if take profit, or if our entry price is at 113.552, so I'm going to grab this and kind of make this smaller over here. So our entry price is 113.552. That we're trading a JPY pair, so we really don't need to look at that third decimal place because we're not going to do all the math all the way down to that third decimal place. So we're basically looking at the second decimal place is our pip. Okay. So let me get rid of this one. Keep that on the same page. And our exit price, our take profit that it says is going to be 113.13. Okay. So the difference between 113.55 and 113.13 is going to be 32 pips. Okay. So if I had 32 plus 13, that gives, or hold on, 32. I'm math wrong already. 42 pips. So 42 pips is the difference between 113.55 and 113.13. Okay, 13 plus 42 is 55. So based on our position size, we already know how many pips that we expect this thing to go before this trade is even setting up. Take profit one from our entry is 42 pips away. So we can decide how big or how small a position size we want to take. So let's say we risk $1 per pip. Okay. So we get in at the price where it says 113.55, and then we get out at that first take profit level, we would have made 42 pips. And if we took let's go back to the PowerPoint. If we would have took a mini position and we took $1 per pip, we would have made $42. Okay. So $42. Now we also have our take profit too. So if we would have continued to hold on to that, instead of getting out at 113.13, we would have got out at 112.81. So that's going to be a difference of 19 plus 55 of 74. So that's 74 pips. Okay. So if we took $1 per pip, that would have been a $74 trade. Now, if you took a bigger position size, if you took that first position size and it was $10 a pip, we'd have made over $300 on that first trade. If we took a standard position size, $10 a pip, and it went to 74 pips down, we would have made $740 off of this particular trade. All right. So the scanner is really telling us where to get in and where to get out. And before we even get into these trades, we already know how many pips that entry and those take profit distances are away from each other. Now let's do the reverse of it too, because sometimes you lose. So you got to know you're losing. So the distance between this green line and the red line above it is our stop loss. So when you put in your trade, you're going to put in the stop loss level as well. And that's basically the price of, if it gets to this price, I'm getting out of the trade. So let's say we get into the same trade again. Delete. Oops, I did not want to delete the line there. Hold on. I'm here deleting stuff that I didn't want to delete. All right, there it is. All right, so we say we get in at 113.55 again, except this time, let's say the trade went against us in the wrong direction and it kept going up to 113.80. And the difference in pips there is 25. Okay. So if it goes up from 113.55 and it goes up 25 pips, that's it'll be up at 113.80 and we'll get out of our trade. Now, if we took $1 per pip risk, then we would have lost $25. If we would have took a $10 per pip risk, it would have been a loss of $250. Okay, so before you even get into these trades, you already know how much, you already can do the math on the position size you want to take getting into these trades. All right, let's take a look at another one, see what's going on here. That one didn't quite get to the entry. That's ugly charts. Okay, here's one. This one's live now, and we'll do some of these on practice accounts once as they're setting up like this, so you can kind of really get a feel for it. So this particular right here is the Euro NZD. Now I want to use something. No, that's okay. It's not based on the 10 scale. That's why I didn't want to use it, but we'll use it for sake of illustration. But we're right at the entry zone here of 166.51. Okay. So scroll down here. 166 or 58 rather is our entry. And our first take profit level is 167.05. 92. 167.92. So see how many pip difference that is? I just throw it in a calculator. So 167.92 minus 166.58. Oops, 58. So it's a difference of 134 pips. So I already know that if I get into this trade now, or let this drop a little bit further back into this entry zone, that's a potential to go up 134 pips. Now the stop loss here is 166.02. Okay. So 166.02 is the stop loss. So that's a difference of 56 pips. Okay. And we'll get into risk rewards and all that kind of stuff as we go through the couple lessons here. So essentially, if I'm taking this trade here, these are the trades that I like. I want to be able to take a trade where I'm capable of gaining twice as much as I'm risking, or 3 times as much as I'm risking. So if we were taking $1 per pip trade on this, and we got in like right now, I would be risking $56 because I'm taking $1 risk per pip. And if I were to win this trade, I can potentially make $134. Now, again, this is not based on the 10 scale, so it's a little, you'd have to use that other calculator I showed you at the beginning, but for sake of example, 134 pips, I'm looking at $134. Okay. If you're taking $10 a pip risk, then I'm looking at either losing $560 or making $1,300. Okay. So we'll definitely do a lot of practice with that, but I definitely wanted to kind of go over pips and pip bets and how to calculate the actual leverage and position sizes. So we'll do some live examples on the charts here next week. Any questions on leverage or brokers or anything like that? Let me know. Let me check over here on both of these platforms because I keep forgetting about this other one over here. All right. All right, cool. All right, so next week, if you haven't done it already, no worries. We're going to actually install the actual harmonic scanner on your MetaTrader 4. So we can do a lot of examples, and that way you guys can kind of play with the tool itself a lot. There's also the web-based version too, but I really want to go through this one with everybody so I can kind of show you MetaTrader 4 for those that aren't familiar with it. So I'm going to actually go through and show you how to download MetaTrader 4, install this software on here. That way you can actually see, how many times does a scanner actually win versus losing, which has about an 80% win ratio. And you can actually see it in action and practice with it. You can see, the yellow boxes are entry zone and the dotted lines are our take profit levels. And simply by, I'm going to show you some trading tools, and how to kind of analyze the market. But if you don't know anything, at a bare minimum, you can at least plug in the numbers just based off the actual scanner. So we'll kind of walk through how to install it and some of the functionality of MetaTrader 4. But again, it's in the IML back office, the harmonic scanner. If you kind of want to go through that, if you want to get a head start and already install it, you're more than welcome to. If you have an error with it, we'll definitely go through how you get certain errors and what causes them, stuff like that. So I will send out this recording. If nobody else has any questions for tonight, I'll send out this recording in the morning. But definitely, if you guys have questions during the week, let me know. And then on Thursday, we'll pick back up and install this. If you've been going through the IML Academy so far, a lot of this should be duplication, just repetitive stuff, and that's really how you learn in these markets. So definitely check those lessons out. If you get a chance, also jump in one of the live sessions. You can kind of get a feel for it if you haven't already. All right, so you guys have an awesome evening, and Thursday, same place, same time. And if you guys have any questions, definitely feel free to reach out to me and kind of look at the charts here as well and kind of practice with those position sizes and lots and make sure you're calculating the pips right. And if you think you're having trouble, let me know. and we'll get it resolved. Make sure you're understanding it right. So I will see you guys on Thursday.